In this module, we are going to study equilibrium in money market, modern quantity theory of money. Money market is a segment of the financial market in which financial instruments with high liquidity and very short maturities such as bonds, stock, etc. are traded. It is supported by an identifiable and active set of operators like financial institutions, central bank, etc. Because of their short terms to maturity, the debt instruments traded in the money market undergo the least price fluctuations and so are the least risky investments. The money market has undergone great changes in the past 3 decades, with the amount of some financial instruments growing at a far more rapid rate than others. Money market funds, the full name is money market mutual funds, pool together the funds of many people. The funds are then used to buy bonds, typically government bonds. Money market funds pay an interest rate close to but slightly below the interest rate on the bonds they hold. The difference coming from the administrative cost of running the funds and from their profit margins. After studying this module, you shall be able to understand the demand and supply of money, understand the equilibrium in money market, know about the quantity theory of money, understand how the central bank can control inflation rate in the economy. We are going to commence our module with equilibrium in money market. The equilibrium in the money market is determined by the intersection of demand and supply curves which have been defined in the following section. Demand for money. An individual's demand for a given number of rupees to purchase goods and services is referred to as nominal demand for money. If we measure it in terms of number of goods that can be bought with that money, then we would be referring to real demand for money. Real demand for money is equal to nominal demand for money upon price level. The demand for money is basically demand for real balances because people hold money for what money can buy. When the price level rises, a person will have to hold more nominal balance of money to buy the same quantity of goods as earlier. The demand for real balances depends upon real income. Demand for real balances is positively related with the real income. As the real income rises, there is increase in the real money demand. Interest rate. Demand for real balances is negatively related with interest rates because holding money in cash involves an opportunity cost, that is, sacrifice of interest income. So when interest rate rises, the cost of holding money increases and people demand less real balances. Therefore, the expression describing the demand for real balances can be written as L is equal to KY minus HI, where L is the demand for real balances, Y is the real income, I refers to the interest rate, K to sensitivity of demand for real balances to the level of real income, and H to the sensitivity of demand for real balances to the interest rate. Given the level of real income Y as Y1, the demand for real balances is negatively related with interest rates. Relationship is shown in the figure. The effect of a fall in interest rate from I1 to I2 is that it increases the demand for real balances from L1 star to L2 star, shown by a movement on the demand curve from T to V. The effect of a rise in income can be shown by a shift in the demand curve because at the same level of interest rate with an increased real income from Y1 to Y2, more would be the demand for real balances L1 star to L2 star. The shift of the curve is equal to K delta Y, where delta Y is the change in income level, that is Y2 minus Y1. Let us move on to supply of money. The central bank of a country like RBI in India controls the nominal money supply of that country. The nominal quantity of money is taken, given, and is represented by M bar. We also assume that the price level is constant at P bar. Therefore, real money supply in the economy is given by M bar upon P bar. Both these variables M and P have been assumed to be exogenous. Therefore, the supply of money is a constant with respect to any given level of interest rate. This is shown in the given figure. Equilibrium in the money market happens at the intersection of the demand and supply curves. The equilibrium point is E1, where the interest rate is I1. This I1 rate of interest corresponds to Y1 level of income and M bar upon P bar, level of money supply. Change in factors affecting either money demand or money supply will change this equilibrium. Next, we will study modern quantity theory of money. The quantity theory of money explains how money affects the economy in the long run. For this, it analyzes the relationship of the quantity of money demanded with other economic variables such as prices and income, transactions, and the quantity equation. People hold money to buy goods and services. The more money they need for these transactions, the more money they hold. Therefore, the quantity of money in the economy is related to the number of rupees exchanged in transactions. The relationship between transactions and money can be expressed as M into V is equal to P into T, which is the quantity equation. In this, M is the quantity of money, V is the transactions velocity, which measures the rate at which money circulates in the economy, P is the price of a typical transaction, and T is the total number of transactions in a period, say 1 year. Therefore, P into T would imply the total amount of money spent in a year on making transactions. This quantity equation is an identity and is helpful in understanding the relationship between the four variables. It tells that if M is the quantity of money in the economy, it must be circulated in the economy V times in order to cover the entire money transactions of the economy. But there is a problem in this model. It is difficult to measure T. Therefore, we try to replace T from the equation by some other variable which is easily determined and which holds the above equality. Now, let us study from transactions to income. Transactions are related to output because more is the output, more are the transactions. Although they are not entirely same, but the rupee value of transactions is roughly proportional to the rupee value of output. So, if we represent output by Y and the price of 1 unit of output by P, the quantity relation can be expressed as M into V is equal to P into Y. Since Y is also total income, V in this variation of the quantity equation is called the income velocity of money, or the number of times a rupee bill enters someone's income in a given period of time. This is the modern quantity relation which is used these days. Moving on to the money demand function and the quantity equation. From the discussion on equilibrium in money market, we can express the demand for real balances M upon P raised to the power D as a proportion of income Y. M upon P raised to the power D. In equilibrium, demand for real balances is equal to their supply, that is M by P. Therefore, the equilibrium equation becomes M upon P is equal to Ky. Rearranging these terms, M 1 upon K is equal to P into Y. From previous equations we get V is equal to 1 upon K. This can be understood as when people want to hold a lot of money for every rupee of their income, that is K is large, then money would change hands slowly, implying a lower value of V. Next we will study the assumption of constant velocity. From the quantity equation, velocity can be defined as a ratio of nominal GDP to the quantity of money. But if we assume that velocity is constant, then the same equation can explain the effect of money in the economy, which is referred to as the quantity theory of money. When velocity is fixed, the quantity equation becomes m bar into v bar is equal to p into y. This shows that when velocity is held as constant, quantity of money will determine the nominal GDP, that is py. In other words, a change in quantity of money would cause a proportionate change in nominal GDP. Now we will understand money, prices and inflation. We now determine how money affects the economy. For this we need the following three relationships of economics which are widely known and accepted. Output Y depends upon the factors of production and the production function. The quantity of money supply determines the nominal value of output quantity equation from above. Nominal GDP is equal to real GDP into P. Effect of a change in money supply. When the central bank changes the money supply, there would be a change in nominal GDP 0.2. Since the production function is the same and even technology is unchanged, there would be no change in real GDP 0.1. And with real GDP remaining constant, the nominal GDP would have changed due to change in price level 0.3. Therefore, the quantity theory implies that the price level is proportional to the money supply. Also, since inflation rate is the percentage change in price level, this theory of price level is also a theory of inflation rate. Quantity equation can also be written in percentage form as percentage change in M plus percentage change in V is equal to percentage change in P plus percentage change in Y. As per our assumption of constant V and constant production function and no technological progress, percentage change in V and percentage change in Y are also equal to 0. Since percentage change in price level is inflation rate, we can say that growth in money supply determines the rate of inflation. Thus, it can be said that by controlling the money supply in the economy, the central bank can control the inflation rate of the economy. Now, let us summarize what we have learned. Money market is a segment of the financial market in which financial instruments with high liquidity and very short maturities are traded. The demand for real balances depends upon real income and interest rates. Therefore, the demand for real balances can be expressed as L is equal to KY minus HI. The money demand curve is negatively sloping as represents the inverse relationship between the demand for real balances and interest rate. A change in interest rate is shown as a movement on the demand curve, while a change in income level is shown by a shift. Since both the supply of nominal quantity of money and the price level are held constant, therefore, the real money supply in the economy is given and is inelastic to the interest rates and is represented by a vertical curve. The interaction of the demand and supply curves of money determines the equilibrium level of interest and real balances. The relationship between transactions and money is given by M into V is equal to P into T. This was the old quantity equation, but it was modified because it was difficult to measure T. The new quantity relation is M into V is equal to P into Y. When velocity is held as constant, quantity of money will determine the nominal GDP. In other words, a change in quantity of money would cause a proportionate change in nominal GDP. The quantity theory implies that the price level is proportional to the money supply, and by controlling the money supply, the central bank can control the price level or the inflation rate in the economy.